Hi everyone, welcome to our video today about Americans filing US taxes while living in Canada. What do you have to know about? When do you have to file? What are the different expat tax benefits you have to use? My name is Natalie Goldstein, CEO of MyExpatTaxes and an IRS enrolled agent, and let's walk through all the things that you have to know as an American living in Canada dealing with your US taxes. So whether it's about what are the filing deadlines, if you need to file taxes, what are the different tax benefits to use to ensure you're not double taxed? What about retiring in Canada? Or just saving up for retirement, such as specific Canadian pension plans like RRSPs, RRIFs. What about having your US IRA? I know a lot of acronyms there, but we need to get through them, right? So you know what's the best way to plan your retirement while living in Canada. Or maybe a different topic if you are self-employed, how to deal with the two different systems of Social Security taxes, AKA self-employment tax. And maybe as I'm rambling through all this now, you're thinking, I have to file US taxes? I haven't done that yet. Well, don't worry. If you haven't been tax compliant, we'll also talk about how you can get caught up penalty-free with the IRS. And of course, if you're on the other spectrum where you're filing annually and you're like, tell me something I don't know, we also will cover MyExpat planning, how to plan for future events such as selling your house in Canada and other topics that might come up in your life. So the biggest question of all, why do you even have to file a US tax return when you don't live in the US? It basically comes down to if you're a citizen, right? Or a US green card holder that hasn't properly given up their US green card with Form I-407 and properly filed, their final tax return. But now I'm getting into specifics. Basically, if you're one of these, right? So US citizen or you are somehow a US person, you are still subject to the same rules as those living in the US. And that is if your worldwide income is over the filing threshold for the year, you have to file a US tax return. So when we talk about worldwide income, it's really worldwide income. It's not just about your US income. So it is US pension, Canadian salary. Maybe you were living in the UK and you have a UK bank there and you have interest income. That also counts. So all different types of income from anywhere in the world that you earn before any type of deductions, before any income taxes or Social Security contributions, that gross amount, if all of that combined is over your filing threshold for the year, you have to file a US tax return. That is simply the US law. What is the filing threshold? So the filing threshold is usually aligned to your standard deduction because it basically says if you earn up to the standard deduction, then you wouldn't owe any taxes because that's, that amount of your income is tax-free. But if you earn over the standard deduction, then you do need to pay income taxes probably. Usually that's the case. Of course, again, it's the IRS. There's always exception. One of them is if you're married filing separately. If you're married filing separately, meaning, hey, you married a Canadian citizen, they don't want to be involved on your US tax return. So you can't file as married filing jointly, but you obviously can't file as single because you are married. Then you might be married filing separately. And if that's the case, your filing threshold is actually a lot lower than the standard deduction because the standard deduction for married filing separately and single is the same. But the filing threshold for married filing separately is $5. That's it. If you can buy Starbucks in Canada, you probably have to file a US tax return. The IRS just really doesn't like anyone that files under married filing separately, which is not great for all of us expats that are married to non-US citizens that can't otherwise qualify for head of household or a different filing status. So unfortunately, that's the case. So a lot of people that are married filing separately, you will definitely have to file a tax return, even if just your bank interest hits $5, right? Obviously, there's another exception, and that's if you're self-employed. If you're self-employed, even if that's not your main job, if that's just, you just have like a side job, if you have any type of freelancing income, self-employment income that you're filing on your tax return under Schedule C, if that net profit is over $400, regardless of your overall worldwide income and if you meet the filing thresholds otherwise for your filing status, if your net self-employment profit is over $400, you do need to file a US tax return because you may be subject to self-employment tax, which is 15.3% of your net self-employment income above that $400 threshold. But we'll talk about that more later, about self-employment taxes, how you can avoid paying self-employment taxes in both countries, and how to make sure you can probably get out of paying US self-employment tax. But it doesn't matter, because even if you can, you still have to file a US tax return. Now that we know if you need to file a US tax return based on your worldwide income and the filing threshold, well, when do you need to file a US tax return is the next question. So there are generally 3 main deadlines. The first one is April 15th. We all know this date. That's the big tax day in the US. If you owe US taxes, we always advise try to file by April 15th because that is the payment deadline. So if you owe taxes, you should pay by April 15th to just avoid any further interest or penalties, etc. If you know that you don't owe any taxes because you've been filing from Canada for a long time, you never owe US taxes, you can wait till June 15th. That is the general deadline for expats that are living abroad on April 15th. You have an automatic 2-month extension. Just remember, if you're trying to claim this automatic 2-month extension, use a tax software or service that is for expats, because there is a statement you have to include in your tax return to say that, yes, I am abroad, I do qualify for these additional 2 months. Now, if you need even more time, you can actually file Form 4868 to get an extension to October 15th. If you need to file this extension form, which you can do for free with MyExpatTaxes, you need to file that form either by April 15th if you're living in the US, or by June 15th if you're living in Canada or you're living outside the US. So you need to file the extension form by the original due date of your tax return, depending on where you're living at that point in time. If, of course, the 15th falls on a holiday or a weekend, just remember that the IRS will normally change the filing deadlines to be the next working day. The only exception here is, of course, for the FBAR. The FBAR is generally due April 15th, but you have an automatic extension to October 15th. So that's basically saying the effective due date is October 15th. However, that's it. It's October 15th, there's no further extensions, and if the 15th is on a Sunday, it's still the 15th. So just keep that in mind when you're thinking about filing your US tax return, and then also when you're filing your FBAR. We're touching mostly on filing your US taxes from Canada. Some basic things to know on the Canadian side is the Canadians do use the same tax year, so that's amazing for your US tax return, January to December 31st. And if you are living in Canada for over 183 days, you probably will be taxed as, a Canadian resident, which is also important to know depending on your US tax return, if you can use different expat tax benefits such as the Foreign Earned Income Exclusion or the foreign tax credit. Canadian tax rates are usually progressive and generally higher than the US tax side, especially when we're looking at federal and provincial taxes together. So usually if you are in Canada filing your US taxes, most folks don't end up owing any US taxes if they're paying income taxes on the worldwide income in Canada. So here comes the juicy details. How do we avoid double taxation? Well, just remember, what is double taxation? Double taxation is when you're taxed on the same income twice. It's actually pretty difficult to be double taxed if you're filing your US tax return properly while living abroad, because there's so many different expat tax benefits. The first one being the Foreign Earned Income Exclusion, where you can exclude up to, for the last tax year, about $130,000 US. That increases every single year of earned income, foreign earned income from US taxation. Couple keywords there. Has to be earned income, so this is salary, self-employment, active partnership income, and it has to be foreign source, meaning you have to have worked abroad to earn that income. So that can be a little bit confusing, because if you have pension income, that doesn't qualify for the foreign earned income exclusion. Or say you're working for a Canadian employer, and then you go to the US and work out of the US for 2 weeks. Well, guess what? Those 2 weeks, your daily salary that you earned while working physically out of the US, that's no longer considered foreign sourced. Anyways, that's the first big expat tax benefit. The second one, which is the one that really helps ensure that you're not double taxed, is the foreign tax credit. If you pay income taxes in Canada or any other country outside the US, for the most part, right? Unless they're a sanctioned country, of course, those credits can be used on your US tax return as a credit against US taxes owed. The foreign tax credit is a little bit more complicated because there's different buckets of income. So it's not that if you're paying a lot of income taxes on your Canadian salary, that you can then use this to offset income tax on your tax-free savings account Canadian interest. That's not how it works, right? Because salary goes into the general bucket, interest goes into the passive bucket. So just keep in mind the foreign tax credit is there to prevent double taxation, but on the same types of income. And then of course, the next level of tax benefits is a tax treaty. And so say Social Security income, you can't use the Foreign Earned Income Exclusion because it's not earned income, but Social Security income is normally not taxed by either country. And so you can't really use the foreign tax credit approach. So what do? US tax treaties are notorious, right? Because they're super long, super lengthy. You think that it covers everything, but as a US citizen and sometimes even US green card holders, it says, actually, we have a savings clause. You can't use 99% of this treaty. Not applicable to you. The US can still tax you however it sees fit, right? So tax treaties are normally kind of useless for US citizens, except pretty much every tax treaty does exempt the clause about Social Security income. And so it says specifically, maybe, the paying country or your resident country can tax Social Security income, and then the other country can't. So that is where tax treaties do come to play. And I will say with the Canadian US tax treaty, even though tax treaties are pretty useless, that one's pretty good, right? Because obviously we have this exemption for Social Security income, but there's also a couple other exemptions when it comes to having an employer pension in Canada, et cetera, et cetera. So those are the 3 tax benefits that really do help you prevent being double taxed. Obviously, there can still be instances where it happens, but generally not. And again, besides the tax treaty, there's a totalization treaty. We'll touch on that in the self-employment section. And then what other benefits are there? Well, these are a little bit more unknown, right? Think of this as level 2.0 when you're filing your taxes of strategizing and optimizing. So if you have children under the age of 17 with a valid Social Security number and you're in Canada and you're a salaried employee and you're paying, obviously higher Canadian income taxes, look at your tax return. Are you filing with the Foreign Earned Income Exclusion approach? Because you might be doing yourself a disservice. Because actually, if you had used the foreign tax credit approach, you might actually get a refund of up to $1,700 per child. Even though you don't pay any income taxes in the US may still pay you a refund. So again, there's expat tax benefits where it prevents you from being double taxed, but there's actually ways to file a US tax return where you might actually get a refund. Even if you pay nothing to the US may still pay you as an expat living somewhere else if, for example, you have children under the age of 17 with valid Social Security numbers and you're eligible for the additional child tax credit. And of course, we can't talk about US taxes without talking about the FBAR and FATCA. So I am sure that as you went to Canada and you opened up a bank account in Canada and they found that you were a US citizen, they probably gave you a stack of papers this high saying, tell me your name, tell me your US Social Security number, and sign off all your rights of us sharing all your data with the US. I've been through it too. Anyways, and this is because of FATCA. And this just means it's a double reporting requirement where the financial institutions abroad have to report all of their US clients' data back to the US Treasury. And you as a US taxpayer, you also have to report that same information back to the US. You do that in 2 different forms. One is the FBAR. So if your combined maximum balances from all your non-US financial accounts exceeds $10,000 at any point in the year, you have to file the FBAR. And that is not a form that calculates any income tax, so you shouldn't be scared of this form. But it is a little annoying because obviously you have to list all of your accounts. You have to list the account number, you have to list the address of where the account is, and what's the maximum balance in that account. Again, remember, it's not a per account requirement. It is if the combined maximum balances at any point in the year combined together across all your different non-US financial accounts, bank accounts, brokerage accounts, pensions that are not Social Security pensions, so not state pensions, but maybe company, private pensions, life insurance policies with cash value, et cetera, et cetera. If that's over $10,000, you have to file an FBAR. You have to report every single non-US financial account on that FBAR, even if they individually did not go over the $10,000 threshold. And then if you actually have over $200,000 or $400,000, depending on your filing status, you might have to file what we call the FBAR 2.0, which is Form 4838, which is the FATCA form, which is the exact same information as the FBAR, but with a few other checkboxes. And so the FBAR is sent to the US Treasury. This is something you e-file. You do not send it to the IRS. This should be done at the same time, generally while you're doing your US tax return. And then Form 8938, if you have to file that form, that is included in your US tax return that is sent to the IRS. I know that's all very confusing. That's why at MyExpatTaxes, we only ask you for your account information once. We've determined which forms you have to file and we send them to the right place. That's what I really hated when I was looking for an expat tax service myself when I first moved abroad, because a lot of the US services, they don't even know about these FBAR FATCA requirements. And there's such big penalties on these forms that it's not just about filing your US tax return, it's making sure that you have all your disclosures, filed for your non-US financial accounts. So as you're spending your time in Canada and you're thinking, hey, I'm probably gonna retire here, it's a great place to live, or you're already someone that is approaching retirement or in retirement, what do you have to know about Canada, the US, the tax treaties, and the different retirement plans that are available in both countries? So the first thing is about the US and Canadian tax treaty. What is in there and what protects you as a US taxpayer living in Canada? So the first thing to just note that, of course, there are provisions about your US IRA. So if you still have a US individual retirement account, right, whether it's traditional or a Roth IRA, there are certain protections there, such as they are recognized generally as pension plans. But of course, with a traditional IRA, that is taxable when distributed. When it comes to a Roth IRA, there may be some other things to look at on if it can still be tax deferred or if it can even be tax-free at distribution. Now, with that being said, let's look at the Canadian things. So Canada has a lot of different investment plans, such as the tax-free savings account, TFSA. That is a little misleading because while it's tax-free in Canada, it's not tax-free in the US. So if you have that and you're thinking, okay, I'm having this nice investment vehicle where I don't have to pay any tax in Canada, just remember any interest you're earning, any other type of dividends or capital gains you're earning, if you're investing in PFIFs, right, which are Canadian pooled funds or ETFs, so basically any non-US funds or ETFs, you might be looking at a lot different set of US tax rules. So I guess what I'm trying to tell you is it's not really advantageous, which you probably already know, to be an American living in a different country when it comes to these different types of investment vehicle plans. But again, it's just always plan what you want to do so you can still contribute to a US IRA while you're in Canada. Just be aware of how that might be taxed when it comes out, or if it is tax deferred while contributing to it. And then of course, if you're going to invest into Canadian plans such as a tax-free savings account or an RRSP, what are you investing in? When is it taxable? Things like that. However, there is good news for plans like RRSPs and RRIFs, where there is a special kind of IRS decision on them to make them tax deferred. So, they're tax deferred, meaning that you can make contributions, you can grow income, but it's not taxable immediately on your US tax return or on the Canadian tax return, of course. Another good thing with those plans is if you have PFIFs in them. So again, these non-US pooled funds or ETFs, they're not subject to PFIF reporting. So that's actually quite amazing, right? We normally don't see those benefits going to other countries, different pension plans or things like that. So that is very special. But again, just remember when you do distribute income from it, it is taxable in the US. So what I'm telling you is at the end of the day, the income from your different retirement plans, most likely taxable in both countries or at least in the US, basically, right? Roth IRA being the one exception where it's not taxable if you have a qualified distribution in the US, but it could be taxable in Canada. The better news there is if you do end up paying income taxes on this income in Canada or the US, you usually can claim foreign tax credits on the other country's return. So if the taxing rate for, say, an IRA is in the US, any income taxes paid there, you can then use those as foreign tax credits on a Canadian tax return. Whereas if you're paying income taxes in Canada on some type of retirement income, you can claim those income taxes paid in Canada on your US tax return. So you should not be double taxed, but of course it can hurt your different investment retirement plans because there's not really such thing as a plan that is tax-free in both countries. And that's something you just kind of have to accept as an American living in a different country. As I have alluded to multiple times, what about self-employment taxes? Because we covered how to prevent double taxation on income taxes, but if you're self-employed, there's a whole nother set of taxes to think about, and that's Social Security taxes, right? And if you're employed, these are automatically generally taken care of. They're just taking out of your salary, and the US is not looking to take out Social Security taxes from your Canadian salary. But if you're self-employed, this is something you have to pay on your own, the Social Security taxes, self-employment tax. For the US, if you're self-employed and you have over $400 in net self-employment profit, you have to pay about 15.3% of that amount over $400 in self-employment taxes. Unlike income taxes, this does go to a better benefit, right? So this helps you get credits in your Social Security benefits account in the US, which means, you can one day get Social Security benefits from the US when you retire. So it's not all bad. It's not like income tax, but it's still a pretty big check to write, a 15.3% cut from your self-employment net profit, right? Because we all know being self-employed is hard enough, and now you have to pay more of it somewhere else for, obviously retirement, but in that moment, it's not that fun. Now, if you're in Canada, guess what? You probably have to pay self-employment taxes in Canada too. So does that just mean you lose about 30% of your income right away for retirement? Not necessarily. That's what a totalization treaty is for. And a totalization treaty is available between Canada and the US. So the important thing is that if you are self-employed and you think that you're going to stay in Canada, you prefer to pay self-employment taxes and Social Security taxes in Canada, just make sure that you're properly registered as a self-employed person in Canada, that you're paying those applicable taxes there in Canada. Because if you are, when you file your US tax return, you can claim the totalization treaty. You can claim that and say, hey, I'm already paying in Canada. I don't need to pay in the US as well. And that will exempt you from paying that 15.3% self-employment tax in the US. It's a little bit tricky sometimes to do this declaration, just because if you really go through the instructions, the IRS says that you should send in a certificate of coverage. In practice, it's pretty difficult to get the certificate of coverage. So what most expats will do is they will just have the records of their Canadian tax returns that they are registered as self-employed, they're paying those applicable taxes. And then when you go to e-file your tax return, you just claim the totalization treaty. Instead of having to paper mail it with a copy of the certificate of coverage. Obviously, the IRS may come back and ask for it. It's very rare that they do, but if they do, you can always then send in your Canadian tax return, and that normally will satisfy them. If you are one of those people that maybe you haven't filed, maybe you didn't know you have to file, maybe you've been abroad for 30 years without filing a single US tax return, don't worry. There is a plan from the IRS to help you become tax compliant. So if you want to become tax compliant, if this is eating away at your soul, keeping you up at night, right, you can go through the streamlined filing compliance procedure. There's two different types of it. One is for offshore, one is for domestic. I'm going to touch on the offshore procedure. So that's for any Americans, right? US taxpayers, doesn't have to be technically an American, can be, US green card holder, something like that. If you are abroad for at least 330 full days in one of the last 3 years, then you can generally qualify for the streamlining plan. Again, considering that your acts of non-filing was due to being, it was non-willful, it wasn't due to tax evasion, right? Obviously. But if, you just didn't know you have to file, you can go through this procedure. You only file the last 3 years of federal tax returns, the last 6 years of your FBARs, and then obviously, aside from the procedure, you would file your current year of taxes and your current year FBAR to really be caught up. And then that's it. Even if you're abroad for 30 years, that's it. Only the 3 back years of tax returns, 6 back years of FBARs. Obviously, with the IRS, there's always an exception. If you do have a limited liability corporation, so a company incorporated outside of the US with limited liability, and it was incorporated before 2018, and you had positive retained earnings on your balance sheet as of December 31st, 2017, you would have to file back to 2017 because of this one-time transition tax. I think most people don't fall into that. So for everyone else, you only have to file 3 back years of taxes. As we come to the end of this video, and maybe you learned something new, I do want to offer that with MyExpatTaxes, we actually have a different service called MyExpat Planning. You're trying to figure out what decisions to make now to ensure your tax situation is smooth and there's no big surprises. So if you're gonna sell your house in Canada or sell a house in the US, how does that impact your US taxes, right? If you're in Canada, could you claim these tax-free benefits such as a Section 121 exclusion? Or maybe you're looking to take money out of your IRA, or you're looking to contribute to it. How does this impact your US taxes if you're looking to make investments into Canadian, pooled funds or ETFs? What is that PFIF reporting like? If you're looking to start a company in Canada, if you are kind of thinking about doing something and you know it's going to impact your tax life, have a look at MyExpat Planning. We do have this really great dashboard where you can go in, you can pick the different topics that are relevant to you: selling property, starting a company, making investments, planning for retirement, educational benefits. Get all of the vetted information about what is relevant for that situation. And if you need even more, you can talk to our tax professionals to help you plan a little bit further on how you can make the best decisions now so that when tax time comes, you're not in for some very unpleasant surprises. Thank you so much for watching. I hope you found this helpful, you learned something new, and it just makes your life easier. And I get it, I'm a US expat myself. Us here at MyExpatTaxes, our goal is to make US tax filings for expats worldwide easier. So if you like this, subscribe for more clear, actionable tips to make your US tax filing from anywhere in the world easier and smoother. Thank you for watching.